Good morning, ladies and gentlemen. With me today, our Vice President, General Manager of McEwen Copper, Michael Medding, and Stefan Spears, Vice President, Corporate Development, is handing out some brochures. Thank you. Safe Harbor Statement, you can read it at your leisure. I have a stalled, there we go. We have a difference, a McEwen difference. My personal investment in the company is $220 million. I own 17% of the company. I take $1 a year in salary. We have 51 million shares outstanding, fully diluted. Our assets are spread through the Americas. We're, I'll call it hard money and green copper. We have gold, silver, and a large copper project. Our gold and silver mines are in prolific regions, but right now they are high cost, short life. Our exploration is aimed at changing that to increase production, lower costs, and extend the life and reduce our debt. Our copper, on the other hand, is large, long life, projected to be very low cost, low carbon, and it's very well financed. And this is just to give you a sense of the underlying value that we see here. There are three components: McEwen copper, a royalty portfolio, and gold and silver assets. And I'll ask you to concentrate on the mid-range of value. We recently completed a financing in McEwen copper that puts a value of $7.48 a share behind every share of McEwen mining. And then we have a small portfolio of royalties on Los Azules, which is the principal copper project, which, if you look at this 27 years, that'd be about $1 billion in revenue undiscounted. And then our gold and silver are measured against 5 of our peers, and saying if we trade at their level right now, which we're not, there'd be an $8.21 value. So we're trading a little around $6.50 right now on the New York Stock Exchange. Mid-range, we think there's a value of $16 a share. I'll speak about the copper first, and we're in the spine of South America. Peru and Chile provide 40% of the world's copper, and Argentina looks like it's going to be a big contributor going forward. There are a number of large copper deposits there. McEwen Copper, we've raised just under $400 million since August of 22 to fund our activity there. And as a result of that, our interest in McEwen Copper has gone down from 68%, which you can see at the top, down to 47.7%. But as our ownership dropped, the value went up from 175 to 382 million. And that's where the 748 came from, you saw in the earlier slide. Now I'd like to talk about how do we get some of these values. Within the same province in Argentina, there are 2 other large copper projects with public market values. So Jose Maria was purchased by Lundin Mining for $485 million in the last year and a half. And another property they control, Filo, is trading at $1.7 billion. So we're all in the same province. We're at a lower altitude. We're at 3,100 to 3,600 meters. So if you went to Beaver Creek, base at Beaver Creek is 2,400 meters. The top of the mountain is about 3,500 meters. I have a home there, and we're at just under 3,000 meters, and it's quite livable. According to the published resources, we have a higher copper resource, larger, and a higher grade than either of those. We're closer to infrastructure, roads, and highways. According to Goldman Sachs, we're in the bottom quartile of the cost curve, and we're in an earlier stage. We have 2 large shareholders. Stellantis owns 19% of the company. It's the 4th largest car manufacturer in the world, and the first time a car manufacturer bought into a copper deposit. Newton, which is an arm of Rio Tinto, they own 14%. I personally own just under 13, and McEwen Mining just under 48%. Rio has come in 3 times to invest in this project, and Stellantis has come in twice. And here's our share price since the beginning of the year. We've outperformed gold, copper, the Dow, NASDAQ, GDX, GDXJ by a significant margin. And you can see it was driven a lot by the copper. It's the 8th largest undeveloped copper deposit in the world and the 4th largest not owned by a major. So it's significant in terms of being a copper project. In June, we came out with a preliminary economic assessment, just measuring, taking into effect the inflationary costs that have occurred over the years. You're looking at a 27-year life and pay initial capital $2.5 billion and a payback of just over 3 years. In the first 5 years, producing 400 million pounds of copper, and the next 22 years, you're out over 322 million pounds of copper. But we'll be mining 0.6, 0.7% copper in the first 5 years, and that accounts for the short payback. In terms of this is a Wood Mackenzie survey of undeveloped copper deposits, and we're positioned in the lower quartile of the cost curve. We will be emitting initially 1/10 the carbon that a comparable size conventional copper mine would be doing. We would be using less than 1/4 of the water. All of our power will be renewable, solar, wind, and hydro, provided by the largest energy company in Argentina. And we're trying to do something different. This is a picture of an architectural rendering of accommodation that's proposed at Los Azules. And it's incorporating some of the concepts the Inca used of terrace gardens. It will grow a lot of its own produce. It will process all of its waste. Locally, it'll be solar and collect all its water. The mining industry is facing a big labor shortage, and so you have to make it attractive. And we also want to change the impression of mining for the public. And we hope that this model one day will be one of the models that the mining industry uses to think about the future, being much lighter on the environment, being able to attract capital that is in unconventional sources, such as PricewaterhouseCoopers has estimated there's over $20 trillion invested in ESG-related investments. And I think if the mining industry shifts in that direction, there is an opportunity to get the capital you need to build these mines. This is just looking at that accommodation. It's tucked into the side of the mountain to get maximum solar. And in there would be a hotel to accommodate families of the workers, but also any tourists, because we want to make this a jewel on the landscape rather than disguise it. There'll be a soccer field as well, just in keeping with Argentina's prowess in soccer, or football, it's called here. I've been in the gold industry all my life, so whenever I look at a deposit, I always try to think of it in gold terms, even if it's a copper deposit. So this deposit, over on the left, you can see it's 37.6 billion pounds of copper is the total resource, and that is equivalent to 68 million ounce gold deposit, and producing an average annual 320,000 ounces, or billion pounds of copper, is equal to just under 600,000 ounces of gold, and at $1.07 a pound, that equates just under $600 per ounce. So to give you a sense of the magnitude of this property. We have a team that Michael has assembled down in Argentina, very experienced mining in this part of the world, a lot of senior experience there. Now we have some exploration potential. These are that dark shape is the outline of the proposed pit. We're only going to be mining less than 40% of the resource, and we see that it continues quite a distance below the bottom of that. I'll just jump in. One of the things that's been holding us back is our precious metal operations. I made a mistake and hired some people that I shouldn't have hired, and we missed on our guidance, and we were just the market did what it should do when someone misses on guidance, and so they lumped it all together. Our production declined, and over the last 3 years it's been increasing, so that's bringing our costs down. And that's in Timmins, in Canada. And in Nevada, this is also one of the laggards in our portfolio. And this is showing the daily gold production and from the beginning of the year. So you can see it on the left down around 50, and right now we're well over 200 ounces per day. And the average year to date to the end of October was 92. So it's coming on stream. Costs are coming down. Production is going up, which is all good signs. We're looking to do 150,000 ounces this year. Still, the costs are still high, but they're coming down. And I think once we see this year over, we'll be on a much better footing, and we'll have two drivers of our share price rather than just the copper. So that's our story, and I'm ready to take any questions if you have them. If not, I'll let the next speaker get up.
No. If nobody has, nobody wants to ask a question, I do have one question. Oh, there you go.
Yes.
Yeah. We can't neglect Argentina and the elections next week. What are your comments on that, and could it have an effect on your project?
Well, where we're located in Argentina, San Juan province, it's probably the most friendly to mining within the country. There are two elections that have taken place. One, there's a change of governor. He'll be taking office, I think it's December. And then there's an election next week for the president. I happen to like the Libertarian, the guy with the chainsaw. But there's the Minister of Finance right now that's also running, and they're going neck and neck. And he throws money out like most populists. Argentina has a very high rate of inflation. And if they get their act together, they could have a lot of foreign investment. But they have to move a long way before that happens. But you can take some comfort that Stellantis is one of our largest shareholders, and they employ more than 20,000 people in the country, so they have a political heft. There's a number of, you have Glencore in there, you have Rio Tinto in there going after the lithium, and there are a number of other large companies in there, Barrick's in there. So all the politicians are talking about supporting mining, but as we all know, politicians say one thing and their actions are often very different. So we're optimistic that we can make a positive contribution to the economy, and they will hopefully embrace us.
Rob,
yes, Tom.
so those are pretty much large leaps in the AISC in Nevada and Argentina. What is that mostly? What, inflation, equipment, labor?
Largely fixed costs and lower production that drove the costs up. In Nevada, there was an unusually heavy snowfall last year. There was spring runoff that caused flooding. We had to take a boat to get into the mine, or a helicopter for a week or two. And so production dove, but it's coming back nicely. In Timmins, it was just improving on what they were doing, more production.
Thank you very much, Rob.
Did you get your question?
No, but that will be the next round.
Thank you.